If there's one stock that means defensive, long-term investing, it's Coca-Cola, ticker KO. But is it still the growth giant it used to be, or has it become just a stagnant dividend payer? Today, we're going to dive deep into the investment case for the world's largest beverage company. Many investors only look at the soda. That's where they go wrong. We're going to analyze how Coca-Cola transformed into a logistics and brand management powerhouse, with a 38% ROIC, return on invested capital, something very rare for a company of this size. We'll cover its competitive advantage, the complex relationship with bottlers, its acquisition strategy, Fairlife and Costa, and of course, the real risks the company faces with changing consumer habits. The economic moat, starting with the core of the investment case, competitive advantage. Morningstar rates Coca-Cola's economic moat as wide. Why? Brand analysis. It's not just about the red logo, we're talking about intangible assets that allow for premium pricing. The company dominates the carbonated soft drink category with 43% of global volume. PepsiCo, its biggest rival, has 16%. That's a 27 percentage point advantage. This creates pricing power. Even with high inflation, Coca-Cola can pass on costs. Between 2020 and 2024, the company increased its price mix by an average of 7% per year, while volume grew by 2%. This proves the inelasticity of demand. Protection against private labels. An impressive fact, the penetration of private label brands, those cheap supermarket ones, in soft drinks is only 6% in the United States. In other food sectors, this reaches 20%. Nobody wants a generic Coke. This loyalty protects the company. Profitability, this competitive advantage translates into numbers. Coca-Cola's cost of capital, WACC, is estimated at about 7%. The projected return on invested capital, ROIC, is 38%. When the return so greatly exceeds the cost of money, you have a machine for generating shareholder value. The sales machine, the bottling system. Here's the part that confuses many new investors, but it's the secret to KO's success. The franchise system. Technical explanation, the Coca-Cola Company, the one you buy on the stock market, basically sells concentrates and syrups and does the marketing. The manufacturing, bottling, and distribution are handled by partners, like Coca-Cola FEMSA or Arca Continental. Refranchising. In 2018, Coca-Cola completed a massive refranchising process, selling its own bottling plants. This dramatically improved the company's margins and free cash flow, as it exited the capital-intensive business, trucks and factories, and focused on the high-margin business, intellectual property and syrup. Alignment of interests. They use an incidence-based pricing model. Coca-Cola earns a percentage of the bottler's final product revenue. This forces Coca-Cola to care about the final price on the shelf and marketing, aligning the interests of both parties. Scale and retail. With $47 billion in sales in 2024, the scale allows for unbeatable distribution costs. For a retailer or a fast food chain, 76% of the largest fast food chains in the United States serve Coke. Coca-Cola isn't just a supplier, it's a data partner. They provide real-time consumption analytics to help retailers sell more. Product strategy and innovation. But the world is drinking less soda, right? Yes and no. Coca-Cola's strategy has changed to be a total beverage company. Diversification. Today, 31% of the company's volume comes from non-carbonated beverages, water, juices, energy drinks. The success of Fairlife. The acquisition of premium dairy brand Fairlife is a case study. They bought 42.5% in 2012, learned, and took full control in 2020. The result? Sales surpassed $1 billion in 2 years. The challenge of Costa Coffee. The purchase of Costa Coffee suffered during the pandemic and has not yet delivered its full potential in the ready-to-drink retail market, although management remains committed. Reinventing soda. For the core business, 69% of volume, the focus is on health and taste. Coca-Cola Zero Sugar grew 14% in global volume. Innovation now focuses on recipes with less sugar, natural ingredients and smaller package sizes, which have higher margins. Innovation pipeline. More than half of the company's innovation pipeline focuses on non-carbonated beverages. They are investing heavily in categories like sports drinks, with the acquisition of Body Armor for $5.6 billion, and advanced hydration. Financial analysis and capital allocation. Let's look at the numbers. Coca-Cola has an exemplary capital allocation rating. What does that mean? Solidity. Cash. $14 billion in cash and short-term investments. September 2025. Debt. Controlled leverage. 2 times. Debt-adjusted EBITDA, within the target of 2 to 2.5 times. Liquidity. Easy access to cheap credit, essential in times of volatility. Margins and cash flow. After refranchising, the company converts more than 20% of revenue into free cash flow. This is projected to rise to an average of 23% in the coming years. Operating margins are expected to expand by about 150 basis points over the next decade, reaching 31.6%. Dividends and buybacks. Coca-Cola is a dividend king. The payout ratio, portion of profit paid in dividends, is expected to stabilize at 60%. They also do share buybacks, but opportunistically, which is a good thing. Marketing. They don't skimp. In 2024, the advertising budget was $5 billion, 11% of sales. This is the fuel that keeps the economic moat wide. Risks and counterpoints. Bulls versus bears. No investment thesis is only full of praise. What do the bears pessimists and bulls optimists say? The bear side, risks. 1. Health. The long-term decline in demand for sugary drinks in developed markets is real. The company needs to race against time to reformulate products. 2. Currency risk. Since 2/3 of revenue comes from outside the United States, a strong dollar reduces reported profits. 3. Tension with bottlers. In times of high inflation, bottlers suffer from costs. In emerging markets, where bottlers are giants, like FEMSA, negotiations can be tense. The bull side, opportunities. 1. Emerging markets. Coca-Cola's per capita penetration in developing countries is still low. There's plenty of room to grow volume in Asia and Latin America. 2. Digitalization. Investment in digital supply chain is optimizing inventory and sales like never before. 3. Costa recovery. If the Costa Coffee brand takes off in the global market post-pandemic, it could be a new growth engine. Conclusion and verdict. To wrap up our Coca-Cola thesis, we're looking at a company with a strong balance sheet, a lasting competitive advantage based on brand and scale, and management that has proven it knows how to allocate capital, whether by returning it to shareholders or acquiring brands like Fairlife. The projection is for organic sales growth of between 4% and 6% per year in the long run. It's not a tech company that will double in size in a year, but it's a reliable compounder, a company that can expand its business lines over time, with protection against inflation and recessions. If you're looking for stability and growing passive income with moderate risk, the Coca-Cola thesis remains strong. Now, I want to hear from you. Do you think diversification into coffee and alcohol will be enough to offset the decline in sodas? Let me know in the comments. Don't forget to like this video and subscribe for more investment insights like this one. Thanks for watching, and happy investing.